Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. Hi, this video is about preparing financial statements. These will be very simple financial statements. They don't include all the things that you're going to need for this to prepare real financial statements, but they illustrate the concepts that we've covered so far, which are how to record basic transactions. So we're going to look at an example of how to prepare a set of financial statements for very basic transactions, and we will be in future videos covering items like accruals and prepayments that we don't deal with in these financial statements. Okay, so let's have a look. So how do we prepare financial statements? Well, we need to take a number of steps. Firstly, we take the transactions that the firm has entered into and convert them into journal entries. So this is converting the transactions into the debits and credits to the various accounts that we need to debit and credit. Secondly, we record the journal entries in T accounts. So we take each journal entry in turn and we record both the debit and credit sides in the relevant T accounts. We then balance the T accounts. So we take the procedure that we use for balancing T accounts. We look at both sides, we see which is the bigger side, and we put the balance on, we transfer the balance across from one side to the other. We extract a trial balance. So a trial balance is just a list of all the balances on the T accounts. So we extract a trial balance and check that it balances to see that we've done all the accounting so far, at least in a consistent way. It doesn't say everything's correct, but at least says we have the same amount of debits and credits. And then from the trial balance, so essentially from the information in the trial balance, we prepare the income statement and the balance sheet, or the statement of financial position if you prefer it, from the information in the trial balance. And then we check that the balance sheet, that the financial statements balance. What does that mean? Well, it means that the profit for the financial year should balance the balance sheet when added to retained earnings. So let's go through these steps for a very simple situation. This is the list of transactions for a company called Cupcake for 1 month in January. Okay. The first transaction is that Cupcake is formed as a limited company and Mr. Byrne invests 10,000 for 10,000 shares of €1 each. So how are we going to record this transaction? What's the effect on the balance sheet and the income statement? Well, that is going to increase our bank asset. Bank, and it is also going to increase our issued share capital, ISC. Issued share capital, The second transaction, Cupcake receives a loan of 5,000 from the Bank of Dublin. This amount is received immediately into Cupcake's bank account. So this is going to increase the bank as well. A loan is where the bank gives us money, so it's going to increase our bank. We might spend it on something later on, but for now it's going to increase our bank account. And then we're going to also increase our loan account. Okay, and it's not quite clear, is it a long-term or short-term loan here, but we're going to increase our loan account. Cupcake hires a machine. The rental is 1,000 for 1 month's rent. This amount is paid immediately to the hire company. Well, now this is an expense. So we're going to have to increase an expense. And to increase an expense, we debit that account. So it's increase or debit machine rental. Machine rental. We call it MR here. And it's paid immediately to the hire company, so it's going to decrease. So it'll be credit bank. Cupcake rents premises. The rent is 5,000 for 1 month's rent. This amount is paid immediately to the landlord. Well, this is exactly the same as the previous one, except we're going to be doing increasing premises rent rather than increasing machine rent. And Cupcake buys materials to make cupcakes for 8,000. This amount is paid immediately to the suppliers. Okay, what are we going to increase here? Well, it's another expense, and in this case, it's a kind of a special one. It's called purchases. Okay, PURCH. And what do we decrease? It's paid immediately to the supplier, so we immediately decrease bank. On the 3rd of January, Cupcake sells all of its cupcake output for the month to its customers. The customers pay 20,000 for all of the month's output. Well, this is an income item. We are going to increase the bank. This is the easy side with 20k. And we're going to increase the sales account. Now, what side is that going to be on? Well, that is an increase in an income item. So that is actually going to be a credit. CR. And the bank charges interest of 25 and deducts this from Cupcake's account. So what is it doing here? That is going to be another expense. So we are going to increase bank interest, BI, and decrease bank. So because the bank have taken it directly out of the bank account. Okay, so that's what happens with all of these transactions. And the next thing we're going to do is we're going to just put together the accounts without it doing any of the debits and credits or any of that. Because this is a simple situation. We can just put the accounts together really without any, data processing. So what have we got? Well, we've got an income statement for the period. The sales were 20,000. That was the cupcakes we sold to customers. We have purchases of 8,000. That was for the raw materials for the cupcake. We have machine hire, premises hire, and interest, and that gives us a profit of 5,975. So that's just pulling those numbers out of the transactions that we saw. We also can work out how much they're going to have in the bank at the end of the year. So that's another interesting thing we can work out without doing any debits and credits. So the opening bank balance is 0. Mr. Byrne contributed 10,000. We got a loan of 5,000. The rented machine went out of the bank. The rented premises went out of the bank. The purchases went out of the bank. The sales of the cupcakes went in, and the interest went out of the bank. And that leaves us with 20,975 in the bank at the end of the month. Now note, I won't emphasize this, but note, what's left in the bank at the end of the month is not equal to the profit. The profit is a different thing altogether. It's income minus expenses. What's left in the bank is just what went into the bank minus what came out of the bank, which is a different thing. What would our balance sheet or statement of financial position look like? And we're still on our shortcut here. So what will we have at the end of the month? Well, we'd have 20,975 in the bank. We have a 5,000 bank loan. That gives us assets minus liabilities of 15,975, and the issued share capital is 10,000 plus 5,975 gives us 15,975. Okay, so what is good about this? Well, the good thing is that the accounts balance. We can see by putting in this retained earnings of 5,975 here, we get the whole thing to balance, that this is equal to that. Okay, so you can see there, just taking a shortcut, that's what the financial statements should look like. And we're now going to go through a more laborious process of doing this using debits and credits, which is not necessary for this example, but you know, for most companies, because they have millions and millions of transactions per month, they obviously need to have a more organized process of putting things together. So we need to go through each journal entry. This first journal entry is the issue of equity share capital. We debit the bank 10,000 and we credit issued share capital or equity share capital. The journal entry to record the receipt of the loan money goes into the bank, so it's debit bank, credit loan. And the loan will end up on the liability side of the statement of financial position. The journal entry to record payment of the rental on the machine rental is €1,000, and that is an expense. Now I've written income statement beside that just to make it clear. That is not the same as these items up here, because this is going to go into the income statement. And we credit the bank. That's straightforward enough because we've paid that money out in rental. And the journal entry to record payment of the rental on the premises. So the premises rental in the income statement is 5,000, and the bank the bank goes down by 5,000. So that's a similar situation. This will end up on the income statement. So the purchases of materials were 8,000. This again is an expense. It's going to be debited to the income statement, 8,000, and the bank account is credited with 8,000 because we immediately paid for those purchases. And the journal entry to record revenue, in this case the bank is debited because we're receiving the 20,000, the bank is increasing, and the revenue account, which is also going to go into the income statement, IS, that is credited with 20,000. Remember that when you're increasing a revenue or a gain item, you credit that item. So look back on the table that I provided in the last video as to what is an increase and a decrease. How do they convert into debits and credits? And the journal entry to record interest, again, this is an expense, so it's going to go into the income statement. Income expense 25 and credit the bank 25. So those are our journal entries. We've created one journal entry per transaction, and we have followed the rules in relation to debiting and crediting items depending on whether they're an increase or a decrease in the various types of items: an asset, a liability, an equity, an income, or an expense. Okay. The next step is to put all these transactions into T accounts. Okay. So what do we do here? Well, we start off with the issued share capital. We're debiting the bank with the issued share capital, debiting the bank with bank loan, debiting the bank with the amount of sales receipts here. Now, all of these items we'll see in a second are going to the corresponding accounts. We've got machine rent, premises rent, and purchases. Now, in this one, we can see what's happening here. So this purchase here, which is coming out of the bank, it's a credit to the bank. It is a debit to the purchases account down here. So those two items that I've just highlighted, they correspond with each other. Okay, and on this side we have machine rent, premises rent, interest. So all of these items will be debits in the T accounts that we are just about to see. So the revenue, we saw the debit to the bank. Here is the credit to the revenue account. Machine rental, we saw the credit to the bank. This is the debit to the machine rental account. Again, the same thing for premises rental. Interest, we saw the credit to the bank. This is the debit to the interest expense. And the bank loan that is over here. We had a debit to the bank account, so we have a credit to the bank loan account there. Okay, and I think there's one more T account, bank interest. Okay. Sorry, there's issued share capital. There we go. Okay. Now, what do we do after that? Well, we balance the bank account. And you should go back to the T account and see how that T account is balanced. Okay? What do we do? What is the procedure for balancing a T account? We add up both sides. We see which is the bigger side. We subtract the small side from the big side, and the difference we put on the small side. That's the balancing out idea. And then transfer it, draw two lines and two double lines underneath, and transfer it down to the other side. So the bank has ended up with a debit balance of 2975, and that makes sense because we have looked at earlier on using the shortcut. We looked at the balance, the amount that we'd expect to be in the bank, and that is 2975. Purchases are on the debit side because they're an expense, 8,000. Machine rental and premises rental both on the credits on the debit side because they're expenses. Interest expenses there. On the credit side we have revenue, bank loan, and issued share capital. So this now puts us in a position, this trial balance here, and I mean you'll be doing much more advanced ones where there's lots of items in the trial balance and you'll be converting them to accounts and later videos. That trial balance gives us all the information that we need, or in this case at least gives us all the information that we need to convert this information into a set of financial statements. And I've just reproduced the trial balance here, gone down through it and said where are these items going to end up. Well, the bank is going to end up in the statement of financial position. Purchases will be in the income statement, revenue in the income statement, machine rental in the income statement, premises rental in the income statement, interest expense in the income statement, bank loan and issued share capital will be in the statement of financial position. So this is the income statement here. We've already seen that. We pick out the items, we put revenue at the top and then the various expenses down here. Add them up, they come to 5975. Then for the statement of financial position, we pick out, the items that we need. There's the bank, and here is the bank loan. Goes in there, and the issued share capital goes in there. And the final step then, I'll just change, can I change the color of my pen? The final step is to take the profit for the financial period and put it down there. If we had retained income already in the company, we'd add it on to the retained income. And that's it. You prepared the financial statements. You've gone the whole way from the basic transactions, just talking about what the company did and how much was involved, put them in journal entries, recorded them in T accounts, extracted a trial balance, and then moved on to financial statements. So the summary here is to record the transactions according to the table, an increase in an asset is a debit, or an increase in expense or a loss is also a debit. An increase in a liability or equity item is a credit, or a revenue in or gain. An increase in a revenue gain is also a credit. And if you want the other side of the table, then you just say a decrease in whatever. Oftentimes it's easier. Most transactions have one side of them going to the balance sheet, and it's easier to think about that side first and then work out the other side, whether it's an expense or an income item. So you record all that, you extract the trial balance, and then you use the information in the trial balance to prepare the financial statements. And when we get more advanced in the book and in the in the problems, you will get trial balances that are already prepared for you. You don't see all the transactions and all the accounting before the trial balance. You just see the trial balance and you have to convert them to a set of financial statements. Thank you very much. Please remember to like and subscribe if you found this material helpful.